Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free Demat account with Alice Blue Financial Services, click the link in the description and fill out your details, and you'll also get intraday recommendation calls and you can learn robo trading software for better trading. Now let's look at the Guppy multiple moving average, which is a technical trading strategy for Now let's look at what is a Guppy multiple moving average. This indicator was developed by the Australian trader Daryl Guppy. The GMMA implements 12 different exponential moving averages, which is also known as EMAs, in an effort to analyze market behavior on multiple levels. The Guppy multiple moving average attempts to identify trends by combining two groups of moving averages with differing time periods. The long-term EMAs represent the interests and the behaviors of investors that have taken a long-term approach to a given market. The short-term EMAs represent traders or speculators who are attempting to capture short-term profits. Now, this is what the Guppy multiple moving average looks like. Here you can see the uptrend, the trend strength, and you can see how the flow of the moving average is getting affected by the various threads. The Guppy multiple moving average is created using two sets of exponential moving averages. The short term, in which is the first sets of moving averages have a relatively brief time frame and are used to assess short-term trading activity. The number of days used in these EMAs are usually 3, 5, 8, 10, 12, or 15 exponential moving averages. This is a proxy for the behavior of short-term traders and speculators in the market. Then is the long term. The second set of moving averages use extended time periods and are used to assess long-term investor activity. The number of days used in these moving averages are usually 30, 35, 40, 45, 50, or 60-day exponential moving averages or EMA. This is a proxy for the long-term investors in the market. Now let's look at the relationship within each of these moving averages groups, indicating the following points and how the GMMA actually works. And let's look at the following points, like when there is an agreement on value, when they are close together, when there's a disagreement on value, and when they are well spaced apart, or when both groups compress at the same time. It alerts the trader to increased price volatility and the potential for good trading opportunities. Next is the degree of separation in the long-term group defines strength, and weaknesses. The degree of separation in the short-term group defines the nature of the trading activity, and the degree and nature of separation between the two groups of moving averages define the character of the trend. One has to trade in the direction of long-term group of averages. One should not use it as a simple moving average crossover tool. Now let's look at the advantages and disadvantages of this indicator. The advantages are the GMA enables effective analysis of the trading environment and the trends. It gives us a better understanding of the strength of the trend. It gives effective evaluation of unusual price movements such as dips and spikes. It follows the trend is the best friend principle of trading. The disadvantages of this are GMMA is not effectively applied to trend less or consolidating stocks. One needs to follow the trading system of GMMA entirely rather using it just like another indicator. And now let's look at the trading technique needed to use this indicator. First is the GMMA crossover. The simplest method for using the Guppy multiple moving average indicator is to trade a basic moving average crossover system using all 12 of the GMMA exponential moving averages. This system would buy when all of the short-term EMAs cross above all of the long-term EMAs and sell when the short-term EMAs cross below the long-term EMAs. And this is what it would look like. And as we can see here, the green arrow when it would be buying and the red arrow when it would be dipping. So we can get an idea of how the GMMA indicator would be applied on the stock chart. Now let's look at the GMMA laddering trading technique. A change in price direction that is well supported by both short and long-term investors signals a strong trading opportunity. It can be applied to both long side and short side. It can be applied to intraday trading and for long-term investment style analysis. Laddering trading technique is simply adding position at every support taken by short group near or around the long group of moving averages. Add long position whenever short moving average group gives bullish crossover within all its moving averages whenever it is near or inside long group, while long group is rising and in buy mode. Traders should use the Guppy multiple moving average in conjunction with other technical indicators to maximize their odds of success. And here is a chart to indicate this. Here is the slight dip in the short term, and but you can see the how the moving average thread is moving the ribbon, and this green arrows indicates when you should buy. So here is the stochastic oscillator to give an idea of how it actually works. And this has been applied on the Bank Nifty candlestick chart. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you would like to create a free Demat account with Alice Blue Financial Services, click the link in the description and fill out your details. You can also get intraday recommendation calls and you can learn robo trading software for better trading.